Oops, got my camera going here. All right, folks, welcome to the weekly spread. Looks like we are ready to go. Just seconds till noon, so I'll go ahead and get Jack and Norman introduced. Pardon me. This week, Jack and Norman are going to be covering naked puts. They're going to be dispelling the myths, in particular, the two reasons why being put the stock should be the least of your worries. Jack and Norman, go ahead and take it away.
Hey, Jack, how are you, sir?
I'm good, Norman. How are you? Thank you, DA.
Excellent. You know, any topic with the word naked, since I grew up really in the 60s, anything with the word naked in it, I'm into it, you know. So I'm really excited about today's topic, you know.
You know, I don't know why they call it naked. That is kind of a weird naked call or a naked put, you know, strange.
Well, I guess they must be talking about, you know, people, I guess, have like to use options as we do in combination to defend and to protect and so on. But to, you know, and that actually a pretty good segue into what we're talking about. The fact that you do something naked doesn't necessarily mean that you've accelerated the risk a hell of a whole lot. In fact, in some of the things that we talk about, I think people would be surprised at what the statistics really are.
Yeah, they're pretty crazy. It's so much more money to be made selling naked puts than there is almost, you know, buying calls, anything else. That's just so kind of, if you find the right stock, it can be so much more reliable. And the yield on them is really high now because we talked about how the margin changed. But the first thing I wanted to address was how the myth of people think one of the most dangerous strategies on Wall Street is selling naked puts. And that is because they have a fear of actually being put the stock or having the stock assigned to them. And that's a fear that you should never have. A fear like emotion shouldn't be in the market at all. It should just be your planning. If you don't like the stock, then you definitely don't want to sell a naked put on it. But if you do like the stock, it's fine to sell naked put on it or more, you know, all kind of different strike prices. And one of the best things about if you do get put the stock is that let's say you sell a naked put on a stock and the strike price is at 80 and the stock is trading at 82. Well, no one's going to put it to you at 80 if it's trading in the open market at 82. Right. I had a client ask me one time, he was so scared of this. He said, well, couldn't someone just put it to me at 80 out of spite? And I said, you know, people in the market aren't that stupid or emotional. They're not going to put it to you out of spite at $80 just to shove it to you at 80 when they could sell it in the open market at 82. So we got all these crazy fears. You know, people are just afraid of owning the stock. They just want the income from the naked put, and that's cool too. You know, I think I've done it on Apple 6 times in a row before I was finally got the stock assigned to me. And with Archer Daniels Midland, same thing. I started out, I had AD Archer Daniels Midland called out on a covered call. So I wanted to get back in. So I sold a naked put a little bit below where it was trading and the stock was trending higher. And I didn't get the stock assigned to me. I just kept the premium. That option expired worthless because the options were out of the money. The next month I do it again. I still don't get the stock assigned to me. 3rd month, I still don't. 4th month, I finally get the stock assigned to me. Now, at that point, I've lowered my cost basis on the stock because I've collected three premiums.
3 premiums, yeah.
But even if I let's go back to that $80 example. If you sell a $80 strike price put on a stock and you get, say, $3 for that option you sold, you get $300 per contract. If you get the stock assigned to you at 80, your real cost is 77 because you received the 3. So if you turned around and sold it right at 80, you'd still make money, right? And the other thing is, if you get the stock, which I like to do with ADM or some of these others, is I immediately start to get the dividend. And the very day that I have the stock assigned to me, I can then start selling covered calls against it. So if you do this right, it's really, really, really hard to lose.
Well, you just added another layer from the standpoint that I know that because you're such an income guy, and that's where I was first alerted to you, an income guy, and an option guy, and the fact that you deal with stocks that give a dividend. This way, you can have that extra layer that you've just talked about. If you get put the stock, you're going to be dealing with a dividend, which is a good thing, you know.
And you know, if you do it the right stock too, I mean, if you got a nice premium on the put side, you're going to get a nice premium on the call side as well. So in this case, it's like the only strategy I know where you can have your cake and eat it too. You know, it's really really tough to lose on it, and I love it. And a lot of people don't do it, and I think they should do it. And one of the reasons I think they should do it is in a bull market like this, you can sell a naked put real close to the price of the stock and get a really high premium.
Mhm.
And the other thing is, you can do it two ways. You can do a cash secured put naked, which means I'm going to sell this put at $80 and I got $8,000 in my account in case I have the stock assigned to me.
Mhm.
The other way to do it, and this really changed in the last few years, and I don't think anybody really knows about this. I was stunned when I found this out, is that if you do this trade on margin, you only have to put down 20%, which means your yield is going to go through the roof because you've got a little bit in it. I'll show you one from this morning. Let's see if everybody can share my screen. I'll try to share my screen.
Yeah, you're coming in. Okay, we can see it.
Okay, so this one was on Devon Energy, which I own this stock. I own a lot of it. It pays a great dividend, and I just love the way it trades. So with this calculator, this shows exactly without this calculator, I couldn't do it. You know, I flunked 9th grade math. I hate doing math, and I don't want all this math problem to be a problem for me or anybody else. So I hired some guys that are a lot smarter than me to come up with this calculator that we embedded on a web page here. So all you got to do is type numbers into these 4 blue boxes and you see your yield, and you could do this on any stock. So Devon's was at 51.04 this morning when I looked at it. This strike price of 48 is below, you know, $2 below, $3 below where the stock is trading, right? And I get $101. I get $101 for selling one contract. Now I do more than one, but we're just looking at one. Now, this is the part that blows me away. And, you know, I got this straight from Charles Schwab's website. And this is their formula, 20% of the stock down. You can Google this and look it up. That blows my mind. You only got to put down 20%, and the puts are out of the money by 304. The margin required per contract is $817.80. Total margin required $817.80. You get $101. 101 times 100 is 101. That means you get $101 and you invested $817.80. That gives you a yield at 12.4%. And this option expires in about 43 days, September 22nd. So that's it right there.
I mean, the whole, you know, we're talking about really the fear that people have in selling options, and 2 points. One is of course the industry. You know, Schwab in this case, they know the risk. They're going to charge a margin that's commensurate with that risk. Right. And here you're telling me, this is the shocking part, that it's 20%.
I know,
which really reflects the fact that they see this as a lesser risk than the scared population that's considering it.
And you know, here's something else that's weird about that, Norman. If you were to buy Devon on margin, you'd have to put down 50%.
Right.
But if you want to buy Devon via a naked put, you only have to put down 20.
Well, I think the fear also, I mean, the fear must come from, listen, when you're selling a put, for those that are new, when you're selling a put, you want the market to go up. I mean, essentially, when you're selling a call, you want the market to go down. You're taking the premium from somebody in the case of selling a call that wants the market to go up. They're buying the call, you're selling put. In the call case, there is room for a bit of fear from the standpoint that a market could spike, a stock could spike with reckless abandon. But when you're selling a put, and you know that's going to benefit you, you know, from that standpoint. It can only go down to zero, which it's not going to do. But the real fear, I think they're transmutating that selling a call fear to selling puts. Do you think that's part of the resistance?
Yeah, I just think that puts have a bad PR. If anything needed a new PR team, it would be puts. People don't like them until, you know, a lot of people have this aha moment. And, you know, I'm known as the guy that can lead a horse to water and make him drink. So I take a lot of people with me down this journey and I show them. And once they get it, once that aha moment, once that light bulb goes off, that's all they want to do. For example, I got this monthly meeting on Google where we do covered calls. And before they got in on the very first class, I told them, hey, here's a sneaky way to kind of backdoor your way into a position on Google, because everyone's going to need to own at least 100 shares to sell one covered call. So if you don't already own Google and you don't really want to run out there and just buy it at the market like I do, you can sell a naked put and have a chance to have the stock assigned to you at a really favorable price. And when I went through that example, like I just did here right there, that's all they wanted to do then. They just wanted to do the naked puts and went so far as to ask me which strategy is better, which one is more profitable, naked puts or covered calls. So I did a whole video on that that I should put out to the list of guys if they're interested. But the only difference is with a covered call, the yield is high, and you can take that premium and buy more stock, or you can get a dividend stock and take that dividend and also buy more stock with that. And that's the one thing, the piece that's missing from just doing naked puts. If you have a strategy of just naked puts, it's where you just want to make as much cash as you can every month without having the stock put to you. But the covered call thing is, in my mind, a little bit better because you have an asset that you're using to create cash flow, you know. Norman, I lost your volume.
I'm sorry, that's it wasn't important. No, I think, you know, the covered call has always been the place that I think most option traders, but people experimenting with options, at least in testing it, that's really where they should start.
Amen.
I mean, it's a given. It used to be the only thing I did, and the only thing, it's still, you know, when I approach options, it's still the first thing that I look at.
Yes, you know, that covered call strategy by itself has made more people more money than all other strategies combined.
Mhm.
And the reason that is because, like you said, it's one of the oldest. Back in the day, that's all anybody did. And you don't need any special approval from your broker to do it. And you can do it on almost any stock. I mean, anybody on here now, if you have any stock, look at what you could get if you sold a covered call on that a month out at a strike price 7 to 10% higher than your cost basis or your purchase price. And if you don't have 100 shares and the option looks good, you can always round up to 100 and then sell a covered call. Or if you have another stock you like and you want to get into it, you could sell a naked put. And just know that if you do that on the right stock, it's hard to get it put to you unless you're really close to the price of the stock in the market, in which case the premium on that would be really high in the options chain. It's going to be the most valuable one. So they're both good.
Betty Jane has an interesting question here. I'm just kind of zooming in on some of that. She says, with selling puts, what do you do at expiration if the trade is losing?
Well, you could buy back the put you sold. That's the simplest way. Or you could take the stock. Now, you know, when people say the put position is losing, I don't know what that means exactly. You would have to say, is this put about to is the stock dropped far enough to where that option is in the money? And then if it is in the money and you don't want the stock, the only thing you can do is buy back the put that you sold. You'll probably pay a higher price than you got when you sold it, but that's how you get out of it. And if you look at paying that price to get out of it versus taking the stock and where you could be in a month with that, I mean, you could sell a strike price at the price you had it put to you at, pretty much guarantee you're going to get called out.
Yeah, you got some options. Listen, most people have never had a stock put to them. What is for those that are unfamiliar, have never had it, I've had it, but can you describe what putting a stock means, and you know how that actually happens, and maybe what you do from there, what you can do with it?
Yeah. Well, when the market closes on Friday at 4 Eastern, the options market closes also. But the CBOE has until 11:39 p.m. Saturday night to fulfill an assignment. So if the stock is, even in after hours, if the stock went below your strike price, or if it was already below your strike price, and meaning the option was in the money, then sometime between Friday and Saturday night, even one time Sunday at 4 a.m, I got the email that I got, not that I read it at 4 a.m, but that's how they do it, you know. So what happens is Monday or over the weekend, you would see that the money you used to put up to do that trade had been used to buy that stock. So Monday morning, basically, you wake up and you own 100 shares of that stock if you've had it assigned to you. And then you look at the market price Monday morning, and a lot of times it could be a little higher than what it was assigned to you, or a little lower. Yeah, we did it one time with Pepsi. I got the stock, and on Monday, the stock was up $3 from where, you know, it had dropped down Friday for whatever crazy reason. Then on Monday, it's back up. I got it. It was a free gift, man, you know. So I just sold it the next Monday. It worked out real good. So Tim says upgrade calculator with the contract price. That is the contract price. Let me share this again. All right, can everybody
I'll
see
let you
it?
know when we see it here.
Do you see it?
Not quite yet.
Yeah.
There you
Okay.
go.
So this is the stock price. This is the contract price, Tim. That 48 strike price put was trading for $1.01. So if I sold this strike price, I bring in that put price. That's the contract price right there. Hope that answers your question. Let me know.
Interesting. So really putting a stock just means that you use the equity you can, you own the stock, and you can do what you want with it. And at that point, I mean, you could defend yourself with a short-term put, or you could, you can do, or you can, what you do, usually the smart thing is just get the hell out and move on to the next option play, you know.
Now, Roy says, what average person in their right mind would be selling naked puts with 4 question marks? Now, Roy, I want you to elaborate a little bit on that, because I think I'm in my right mind. I don't, people call me crazy, but I think I'm in my right mind and I sell them. So tell me why a person in their right mind would not sell naked puts. See, I think you got the same feeling that most people have. And
Let's see if we get
George says, did the margin only cost 20%, or did it cost you 100? So if I do it on margin, George, it's only going to cost me 100. If I do it as a cash secured put, then I need 100% of the money to buy the stock. So I do cash secured puts in my IRA because I don't have margin in there. And I use margin outside of that. Commission is, there really is no commission. It's just $6.50 fee. So that'd be $6.50 out of my 100 so bucks. Can't get around that, although I'm trying to get around that. So that's that. So Roy, come on, man. Type in what person in their average mind would be selling naked puts. Tell me what you mean by that. Do you think it's crazy or risky?
My guess is that he knew somebody that did and got caught or something.
Yeah.
Let's see if, don't make us assume there, Roy.
Yeah, don't make me assume, Roy. Dan P says selling naked puts is how smart money makes money off our put buys, which lose 90% of the time. Yeah, that's right, Dan P. The seller, this is the funny thing about options is it's just a contract between two people. It really is just a contract, and the contract expires. That's the expiration date. But the funny thing is between the two people is the guy that buys the put, he pays for the put, and the guy that sells the put, the money that the guy paid immediately goes into the seller's account, immediately, guaranteed by the CBOE. Now, I would think that you would only get paid as the seller if that trade worked out at expiration, right? That'd make more sense, but it's just weird how option sellers, you're the bank, you're working with the money right there, right? Okay, we got it from Roy.
He says most average people do not have the funds to buy the stock if forced to do so. If I bought 100 shares of a stock worth $50, I would need $5,000 in cash to honor my position. No?
Yes, that's exactly right. But if that stock paid a dividend and had a high premium, you'd make a lot of money on that. And I think average traders have 5,000. I mean, we've done surveys, and I mean, that might be too much money for some people. And I'm not judging. I'm just saying that, it all depends on how much capital you have.
Well, Doug, you see that from Doug? He said he tried puts on Google, never got filled. He just collected the premium.
See, I think Doug
put
in my Google class because we talked about that, and people like Doug would absolutely love it. So just think about that. I mean, one of the things about selling options is if you sell an option and that option is out of the money at expiration, it's going to expire worthless. And I don't know anything in business that you can sell on a Tuesday and the guy that buys it's worthless to him on Friday.
Mhm.
Maybe fruit or vegetables, or flowers business, but the stock market business, can you believe this? I mean, once I got that figured out after getting killed buying options, man, and still to this day, I just absolutely love selling naked puts and seeing that hit my account. Doug did it too. He tried to get Google put to him and he never got filled. He just collects premium. So this is why I say this strategy as an income strategy, you can set this up to do it every month and you'd make nice monthly income, almost passive, so to speak. Yeah. So Richard says it would only cost Roy 1,000 if he did it on margin, not 5,000, which is correct. Right. So then you got $5,000 worth of stock for $1,000, Roy. So, it's just, you got to look at it different ways. Everybody just, there's more than two sides to this coin. It's more like a cube, there's different ways, different lenses, different ways to look at it. But just doing naked puts on a monthly basis is awesome. Just
well,
like
in dealing with traders on the mental side, which I do a lot in my end of the business, it's always, there's something very deep seated about down is bad and up is good, and puts means down, and there must be something unreasonable, something fearful. There's a fear that comes up just from that basic, just that basic print that you have, until you start to work with the figure, which is why I like the fact that you showed something in the actual figures. And therefore, when somebody even hears the word put, they'd much rather, listen, going up is understandable. Going down, how can you sell something and then before you even own it and then buy it? There's a lot of confusion around puts, not only from the down is bad and up is good, but from the, the confusion about how a put works in general. I mean, how can that be?
Yeah, it's strange. So Betty Jane says, can you collect the premium even if your trade is not filled? Now, you have to have the execution on your option to be filled, but the cash is going to hit your account the second that your option order is filled.
Mhm.
Yeah. No, the other thing is too, when we started talking about this in the 90s, selling naked puts, I would always say to people that were hesitant about getting a put, I'd say, no matter the stock, and I still say this today, do you think when you got it assigned to you, do you think that's the lowest that stock is ever going to be or the highest it's ever going to be? Do you think it's ever going to be higher than this? Yeah,
Mhm.
right. You don't get it put to you, and that's the lowest price, or the highest price the stock is ever traded at. You know, these things time always heals these wounds, right? So, I mean, we just had this with ADM at 110. Guys freaking out that they get it put to them at 110. 3 days later, it's 115. So,
Right.
you know, if you're doing this on the right stock, you might have a paper loss for a while, but it's really, really tough to lose if you're not doing it right. So here Cecil says, so is it best to sell 3-day weekly cash secured puts or sell the monthly? Well, if you do the monthly, you're going to avoid 3 times the commission. But one weird thing is the weeklies are priced higher. You know, if you looked at, if I did this trade once a week versus once a month on a covered call, for example, it'd probably be more profitable doing them once a week. And the weird thing is the weeklies are just priced weird like that. Like the CBOE starts to set those prices. So I think you probably end up net making more if you did it monthly. I think that 30 to 40 days out in expiration is a really sweet spot, because that way you can do that trade 11 to 12 times a year.
You know, my advice to somebody who is listening to us and saying, well, you know, I'm still not sure. You know, it's really like anything. I mean, this is proven stuff that we're talking about. We're showing you the numbers. The thing though that it's important is that just maybe start small. You know,
Yeah.
Sell one put on an inexpensive stock. So this way you can kind of put your toe in and make it. Once you see these, once you see it working for you,
Yeah.
2, 3, 4 times, 5 times out of 6, 8 times out of 10, you're going to start saying, hey, if I had taken 2 positions instead of 1, this would have been the result. So you start building your confidence, because you really do have to break this put mentality that puts are bad and they're more risky. I mean, if they were, the margins would be all different, which is what we talked about before. But starting small, that's the key to breaking those deep-seated feelings that you have that are really incorrect.
Yeah, they are. And I'll even go so far as to say most people don't know this, but this would be, if you have a little time on your hands, look this up today. So Warren Buffett, you know, privately, he just talks about the old buy and hold stuff. But there's a public, very, very interesting story. He made $7 million in one day selling naked puts on Coca-Cola. So I think at the time Coca-Cola was trading at like $39, and you know he loves this stock. And he had a naked put in there at 35. He got $7 million. That's how much of that put he sold. He didn't get the stock. Took him a while to get the stock. But he never talks about selling naked puts, but the article talks about this as Warren Buffett's little secret. He still does it. You know, and then you turn around and years later now he's making, you know, a couple million every quarter on dividends from Coke. He did it on Apple. That's another one of his things, you know. So Charles Joyce says, do other brokers besides Schwab allow you to do it with 20%? Yeah. One firm, one guy showed me was 15%. And I don't know which one that was, but yeah, all of them are pretty much now at 20%.
Yeah, we're seeing a lot of people right here that are supporting what we're talking about, that are experienced. But I love selling premium.
Yeah. Once you get it, you get it. You know, we did it on, one of the problems was, just like Roy said, that takes a lot of capital if you're doing it on 100% cash secured basis. So we found some lower price stocks. I don't know where Snap is now, but back then it was like $24. And we just found a lot of stocks down in the 20 and $30 range, 2,000 to 3,000 in cash secured put that worked really great. So you might just do a little scan or look for stocks that you can afford, and then look at how what all you got to do. Cecil, I don't look at a Gamma or any of the Greeks. I don't do any of that. All you got to do is just divide the premium you get by the stock price, and that'll tell you what your yield
Right.
is that on a cash secured basis, or you could do it on margin. So yeah, either way is good. Like I say, I do it cash secured in the IRA, and I do it on margin in my regular trading account. Uh-oh.
I'm on.
He's
Gentlemen,
back.
we are rolling hot. You guys have a lot of information, but look, it's getting close to 12:30. So I just wanted to do a little bit of a recap. And as a matter of fact, we have a couple of questions that didn't get answered yet. So I just wanted to put those out there. George asked, he probably asked this later in the chat in a different way, but I just want to put this out there. If you are put the stock, you still have to come up with the full price of the stock, correct?
Oh, well, if you did it on margin, you only have to put down 20%. If you do it on a cash secured basis, you have to have 100% cash to buy the stock if you have it put to you.
So for you, David, it would be cash.
Perfect. All right, let's see. Richard asks, only would cost him $1,000. Oh, actually, he was answering another question from the chat. Only would cost him $1,000 if he bought on margin from his account. He was talking about the $5,000 you would have to come up with if you were put the theoretical stock that Roy mentioned. Let's see here. Ken looks like he's a big fan. He says, I sell puts / calls on a weekly basis, the wheel strategy. Loving that. JH, I'm looking at selling a put on a $20 stock in my Roth IRA. So sell to open 5% below and collect roughly 50.50 or 500 income. And if put to me, I need $2,000 in account. Is that all seem correct? Does that all seem correct? And
Yeah,
weekly
2,000 minus the amount that you received in premium with your broker. So they won't even charge you the full 20%, which is even more crazy.
That's a big comment. I got to remember to pick up my copy of War and Peace.
Yeah.
Donna says she loves selling premium. She's been in DVN several months, up over $800 selling calls.
Yes.
Fantastic, Donna.
Beautiful, Donna.
Very good. With relation to that, we've been doing this show now for several weeks, and each day, Jack, you're giving a thing, something that people can try out. You're being definite about, which is what I really like about this whole thing that we're doing. But I just urge people to take these ideas that Jack has, because he's really an idea guy that he's put into play for cash. Try some of these things on a small basis. This is an easy one to try, to sell a single put, in the way Jack has constructed that you do it. Not all of this stuff is going to fit, but some of it will. And when you find something that fit, that's when trading really becomes an enjoyable thing, because it's the best part of trading is when you find something and repeat it over and over again and make money, which is really what I liked about the whole dividend thing you can count on, the whole income thing that you can count on. But this is a process that even somebody who's not that income oriented can take advantage of, because listen, the big money in option is made on the short side. I mean, that's just the way it is. Yeah. And I think that you've got to experiment with it yourself. So if you're finding some of these things interesting to you, give it a try on a small basis and let it work for you. I think again, when you can discover that thing, trading just changes completely.
That's funny. That's a funny story. I knew a young guy when I was starting to get onto the income side real big, and he says, Jack, that's a bunch of shit. Why do you, to me, it was predictable, low risk. I loved it. I mean, he wanted those big hits, and just that's what traders do. It's 2 months later, with his tail between his legs, he calls me up, says, Jack, how do you do that naked put thing again? I need to rebuild my account, he says.
Yeah, that's the worst, rebuilding. You got to put aside, have fresh money and start over. Rebuilding is not a thing you should have in your head. It sounds like too much work.
That's right.
Excellent. Thank you, gentlemen. It is 12:33. You guys have over-delivered yet again. Thank you so much. You guys can sign off. I'm going to go ahead and just recap the things we've learned.
Great to see you.
Great to see you, Norman. All right, DA, thank you.
See you, folks. All right, everyone. Let's see. We got a lot of information today, so I'm going to try to keep this organized. I took some notes. And hopefully, let's see, here we go. All right, started off, people are fearful of naked puts because they're scared of being assigned the stock. Jack said there's a lot of crazy fears, including one guy who asked him, well, what if the stock is trading at 82, but I sold an $80 put? Would somebody just put it to me out of spite? And Jack said that it's ridiculous, basically. No one would do that. you know, for the extra $2, they will sell it on the open market. So he also said, if you're doing it right and you've picked a good stock, it's something that you want to be assigned anyway. So totally fine. It should not be a concern to be put the stock. Just make sure you're picking the right stock. Jack also had a case study he mentioned, ADM, Archer Daniels Midland. He got called out on a covered call, so he wanted back in. What did he do? He sold a naked put. That option expired worthless. Next month, he sold another naked put. That option expired worthless. To make a long story short, he did not get assigned until month number 4. And keep in mind, this is something that he wanted. By that point, he had lowered his cost basis so dramatically that he already was in at a huge profit without even having sold the stock. Let's see, he used the example, if you get assigned at $80 and got $3 from selling the premium, you can turn around and sell it right away for $80 and still make money. Or you can start selling covered calls against it and make money that way. Continue to lower your cost basis while you wait for it to be called away from you. Let's see. In a bull market, you can sell a naked put close to the money and get a good premium for it. Let's see. You can get a cash secured put, which means you have the cash to cover the stock purchase if you get put the stock. But there is another way, which is relatively new. Very few people know about this. If you do the trade on margin, you only have to have 20%. This is shocking and makes the trade so much more profitable. Norman commented on that, saying it's a reflection of how low risk a trade brokers see this as. Jack also showed us his naked put calculator. He flunked high school math and doesn't want to have to do math in order to get a trade out. So he has this calculator that figures what his profit's going to be before he even enters a trade. That is a paid product as part of one of his products. So that I won't be able to post a link for here. Jack was asked which was better, naked puts or covered calls. He did a whole video on this. I'm going to ask him if we can share that. I believe we can. And if I'm able to, I will go ahead and put that in the replay, which goes out by email. Let's see. In Jack's mind, covered calls are a little bit better. Norman says covered calls is where people should start experimenting with options if you haven't done it before. Covered calls, Jack says, covered calls have made more people more money than all other strategies combined. That sounds impressive. You don't need any special approval to do it, and you can do it on just about any stock. He gave us some rough guidelines on how to do it. Sell a covered call 7 to 10% higher than the current stock price. If you don't have 100 shares to do that, you would need 100 shares in order to sell that covered call. If you don't have 100 shares to do that, you can sell a naked put to get in the stock and have it put to you at a discount. Keep in mind the ADM case study. It may take you several months to do that, by which point you will already have a profit going into the trade when you are assigned. When the market closes, some folks asked, how long do you have to get assigned the stock assigned to you? Jack says, when the market closes, the options market closes as well. The CBOE has until 11:39 p.m. on Saturday night, very weird time, if you ask me, to assign it to you. Monday morning, you would see that you were assigned the stock and the money has been taken out of your account. Jack had this happen with Pepsi. And to show why the fears are unjustified, he said the following Monday, it was $3 up from the price it was put to him at, and he sold it, a free gift, he called it. Let's see what else. There are very few, this is a good one. There are very few things in business that you can sell on Tuesday and have no obligation past Friday. The guy who bought the naked put from you has something worthless in 4 days. The only other things that work like that are fruit and maybe flowers, even milk lasts longer than that. We heard from various folks who said they sold naked puts and never gotten put. They love collecting that premium. That's fantastic. And let's see, Jack also says time heals all wounds. If you're doing this on the right stock, you might have a paper loss for a little while, but you can still exit successfully. That's right. Sell covered calls against it, or just sell the stock when it goes up. Someone asked about selling weekly versus monthly. It could be, it would probably be more profitable to do it monthly. You can do it 11 to 12 times a year, but weekly puts are weirdly priced, so you can do those as well. And I know that one of Jack's programs does that, in fact, so that is a viable strategy, doing it weekly. Norman's suggestion, start small, do one contract, watch it work for you, and you will gain confidence in doing it. I can attest to that. In fact, what I would add to that is go ahead and paper trade it. Paper trade that for a couple of weeks or a couple of months, see how it works, see how rarely you are put the stock, and then you can move on to doing it in a real account. Again, start small, one contract, till you gain confidence and you're certain of what you're doing. One of the last things they said, Warren Buffett talks buy and hold, but he made $7 million in one day without having the stock put to him. I think that was on Coke, Jack said. He never talks about it. It's quote unquote Buffett's little secret. That's right. He always says people should buy an index fund and ignore it for the next 40 years, but he's out here doing naked puts. So that is about it. Folks, let me take a look at the chat. Some folks are asking for the replay. That will go out by email. If you got the link that brought you here by email, you will also get that by email. Keep an eye out for it. Let's see. So when we sell to open a put, then we own stock if it goes below strike. Yes, that is correct. Normally I wouldn't answer trade questions, but that's a fairly simple one. JH. What type of trade does Jack use in income calendar? That I cannot tell you. I don't know what trade he's using, but I believe it is some type of options play. Replay link, yep, that's going to go out by email. Replay. Wow, a lot of folks asking for replays. Thank you. A lot of ifs in this presentation. That's Roy. Very skeptical of naked puts. That's fine. That's fine, Roy. Next week we'll cover another income trade. Maybe that one will be something that you're more into. Totally understand. I myself have that same fear. That's why I've been paper trading naked puts and kind of building my confidence that way. Valerie says, can I get a link to all of this, to all of these naked put calls? Is it a series of 3 calls? No, Valerie, this has just been this week. We cover different income related topics every week. If you keep an eye on your email, I'll go ahead and send out the replay for this week's episode. And in that, when you click through, there will be a link to get all the other episodes, which you're going to love. If you love today's episode, you're going to love those. Let's see. Christian says, I got this message from my broker. Our records show that your account contains one or more options that are approaching expiration and may be near or in the money. You have to review your account, determine if you have enough equity to take on the signed positions. What do I do? All right, that is a trade question. That is a Jack question. I won't be able to answer that directly, but I do know that Jack will answer. If you're a subscriber to his services, Jack will answer questions. support@jackcartertrading.com. Just make sure you are a subscriber because I don't believe he can answer to everyone. Tim, thanks TA, got to go. All right, Tim, thank you for coming. See you next week. Spread the word, by the way. Had a nice crowd today and I'd like to see that keep growing. Replay. All right, everyone asking for replays, just keep an eye on your email. If you got an email that brought you here, you will also get an email with the replay. Any questions? Drop them in the chat. Otherwise, I'm going to go ahead and close down the room. Thank you, folks, for everything. Email for Jack, support@jackcartertrading.com. Again, you will have to be a subscriber to one of his paid services for that. Otherwise, all right, I'm going to go ahead and close down the room and see you guys next week. Spread the word. We'd love to see this crowd keep growing. A lot of great questions this week. Talk to you next week.